G'day listeners and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian housing market and everything that's going on in real time. Story number one, Chalmers puts the brakes on negative gearing reforms. Article by Mayor Garaka Đurđević from REVs. I hope we got that one right, guys. Chalmers has put the brakes on any changes to negative gearing and capital gains discounts, emphasising that the solution to Australia's housing crisis hinges on boosting supply. Treasurer Jim Chalmers has confirmed that the government's focus remains firmly on increasing the supply of homes rather than altering existing tax incentives such as negative gearing and capital gains tax discounts. Speaking to ABC's 7:30 report from Washington this week, Chalmers said, "I think it is primarily a supply challenge. One of the reasons why we're not going down the path of changing the negative gearing arrangements, abolishing negative gearing or abolishing the capital gains tax discount is because we haven't been convinced that it would have a positive consequences for supply. We're focused almost entirely on supply. There aren't enough homes for Australians to live in. The housing pipeline is not anything near what we need it to be," Chalmers said. Last month, Chalmers revealed that he had tasked Treasury with exploring potential measures to limit tax concessions for property investors. This admission came amid rising pressure from the Greens to tackle housing affordability, with the party linking support for key housing policies to changes in negative gearing and capital gains tax. But while keeping Treasury's modelling under wraps, Chalmers stated this week, "We all need to do our bit when it comes to investing in building more homes, and that's our focus. And that's why we're not going down the path that has been suggested to us by others when it comes to some of those tax arrangements." Economists long argued this perspective. In September, AMP's chief economist Shane Oliver pointed out that tax concessions accounted for only a tiny fraction of the reasons behind high housing costs. He noted that the real issue is a significant gap between housing supply and the demand driven by population growth. Reducing the after-tax return for investors may lower house prices in the near term as investor demand falls, but will likely boost them over the long term as less investors will mean less rental supply, putting upwards pressure on rents and prices, Oliver told Investor Daily. The coalition has stressed that there are no circumstances under which it would support any reforms to negative gearing. So guys, really good news coming out. Obviously that pretty much at all levels of government, of both Labor and Liberal, are saying that they will not touch negative gearing or capital gains tax reforms as well. Something that we were stressing in a pretty big way last year when a lot of people were getting very stressed about it was that it's almost unfathomable that they would change something that's like a 40 to 50 year old tax incentive to keep people owning rental properties. And we thought that it would create more problems and more stress to the housing environment, specifically to people trying to rent. And that in turn would increase cost of living pressures and effectively rising rents from that perspective too. So really good to come out on that front, guys. I didn't think it would happen, and obviously it hasn't happened from that front as well. So good news for anyone, especially with obviously high interest rates at the moment. High interest rates meaning it's more expensive to hold property right now from an interest rate perspective too, and a cost of debt perspective. So really good that nothing's obviously going to be touched in that. And I think with how much the upcoming federal election, is coming to the fore, I think things like this, they've had it happen to them in the past. They've tried to bring these reforms in very late to the party and actually turned the tables against them as well. So I think they're very wary of something similar happening in this instance too. So all in all, guys, good news. Not looking to make any changes at a federal level to any of those taxes, which is only a good thing for status quo and the market remaining as it is right now. 3% buffer to remain from APRA by Annie Kane from The Advisor. APRA, the prudential regulator, has maintained that the 3% buffer will remain amid widespread calls for the regulator to move to a dynamic buffer. While banks do have the discretion to drop the buffer as an exception, APRA has said it believes maintaining the serviceability buffer for banks at its current level of 3 percentage points over the carded rate is appropriate. In reaching the decision to keep the setting steady, APRA noted rising household indebtedness and a pickup in credit growth, persistent cost of living pressures, a weakening jobs market, and heightened geopolitical risks. Balanced against these risks, APRA said that bank lending standards remain sound and non-performing loans remain low. In its information paper outlining the reasons for APRA's decision, the regulator elaborated the sources of economic uncertainty have shifted over the past year or so, but the risk of shock for borrowers remains. Risks in the global economic environment which could impact the Australian financial system also remain pronounced, including those from ongoing geopolitical instability. We'll get into this in a little bit more if you guys are like, what the hell does any of this actually even mean? APRA watching credit uptick carefully. This article continues, against a backdrop of high household indebtedness, the pickup in credit growth over the past year is an area APRA will continue to watch carefully. It is important that the quality of new lending, including the level of serviceability buffer applied in lending decisions, remains prudent to guard against a future buildup of credit-related vulnerabilities. While overall housing credit is growing at around average rates, the serviceability buffer is operating as expected in constraining a small share of borrowers seeking to borrow at or near their maximum capacity. APRA considers the impact of the serviceability buffer on access to credit, including for first home buyers. Currently, the proportion of new lending to first home buyers is in line with long-term averages. Further, accumulating sufficient deposit funds remains a primary constraint to prospective first home buyers entering the housing market in most instances, reflecting relatively high levels of housing prices. APRA Chair John Lonsdale said since APRA's last announcement regarding its macroprudential policy settings in July, inflation has continued to moderate and the risk of higher interest rates has receded. But we are mindful of potential shocks to household incomes from a slowing labour market. That risk is exacerbated by the uncertainty in the global economic environment, including geopolitical instability. Credit continues to flow to households and businesses and is accessible to good quality borrowers. Although house price growth has eased, prices are still 40% higher than before the pandemic, and household debt is relatively high to incomes, both compared with long-term trends and relative to international peers. This high household debt is a key vulnerability if adverse economic scenarios came to pass. We also have seen an uptick in non-performing loans with potential for further rises, especially if unemployment increases. Now, in this article, the broking industry also calls for a dynamic buffer and goes into detail on this. The decision goes against growing calls for the regulator to be more flexible in setting the buffers, with the broking industry telling the Senate inquiry into the financial regulatory framework and home ownership that while the concept behind a buffer was sensible, the blanket approach to how it is applied and its inflexibilities were not. For example, industry representatives argue that 3% buffer disproportionately affects first home buyers with small deposits on lower incomes, limiting their borrowing power and access to home loans. But a dynamic buffer that adjusts with interest rates would improve borrowing access when rates are low and provide more responsible lending practices when rates rise. Speaking earlier this year, CEO of the MFAA, Anya Panek, added in our refinancing and mortgage stress survey results released earlier this year, our members confirmed that serviceability continues to be the number one barrier for clients looking to refinance, with the 3% APRA serviceability buffer rate being a key factor in borrowers being unable to meet serviceability requirements. We believe there should be greater flexibility for lenders to assess applications using the 1% buffer for like-for-like refinances so people can move to a loan better suited to their current needs. Managing Director of the FBAA, Peter White, also told the advisor earlier this year that he believes the serviceability buffer is still too high, despite it not changing the dynamics of lending today. We're in a marketplace where interest rates are stable. I don't see rates going up again for quite a long time. White said, 3% in my mind is still too high. I'd like it to be around 1.5% to 2%. Look, guys, pretty lengthy article on that, but obviously the APRA serviceability buffer rate has been in contention for quite a while. A lot of people have been talking about it pretty much since the RBA finished its rate cutting cycle. The one thing that people have to take note and really take into account with APRA is it literally stands for Australian Prudential Regulatory Authority. They're literally, the idea is to be prudential. Like they're worrying about what's happening and making sure nothing goes beyond prudent regulations in the banking industry. It is not in their best interest to reduce things to an extent where it is more easily accessible to get money. It is literally the exact opposite. It is how do we keep, how do we keep people who shouldn't be getting funds from getting them? And in a time like this, like they're saying, their biggest worry is the economy obviously potentially moving into recession, a weakening labor market, and people's household, higher than average household indebtedness, and people being worried about stresses, right? How high cost of living and the stresses associated around that as well. I'm understanding what people are saying, especially with the brokers. If it's a like-for-like loan, so a lot of the time, especially if they took out a loan at, say, 2.5%, 3%, serviceability buffer rate would have taken it to 6%, but now a lot of interest rates are at 6 to 7% with still the 3% buffer on top. Now, if they were going for like, say to refinance to a 6 to 7%, that it should be easy to do so. The issue is, and this is where they're asking for flexibility. So it'll be interesting to see what happens here, because they're asking for flexibility around things like that. Easier for first home buyers to get into the market and some flexibility around that, but also for refinances. So it's going to be interesting to see what sort of happens with it. APPA really don't care with people lobbying against them for this thing. They're looking at everything to make sure Australia does not get overextended from a debt position of household income compared to debt. And they already know that there's some stress out there right now as well. So whilst people might be trying to refinance to actually try and get themselves into a less stressed position, like maybe they're trying to shave off 0.5% to 1% interest rate, I think that's where these brokers and the broker associations are trying to get a bit of flexibility. It'll be interesting to see if any of this stuff plays out. The biggest issue is if they did change it across the board, if they were to change it from a 3% buffer back down to a 2% buffer like it was during COVID, even before interest rates, while interest rates were super, super low, it was still sitting at 2% for ages. It wasn't, for a little bit that they actually put it up to the 3%. So it's going to be interesting to see how they do it. I don't think they'll do a blanket approach anytime soon, just because if they were to cut 1% off a loan, buffer rate across the board, 1 to 1.5%, 2% across the board, it's just going to mean everyone's serviceability increases by that amount. That's not prudent lending. It's not something that they're in the business to do. So it's going to be interesting to watch how it plays out. I still think we've got some time until they do ease the buffer rate. They were talking about it like literally 2 years ago when interest rates hit pretty much its peak. But they're going to be keeping this thing as high as they can for as long as they can until they actually realistically do need to trim it back. Something to note, though, and something to watch, because it will add for investors serviceability back into our pocket when the time is right. But again, they're holding a pretty high hold on this thing that they're not going to reduce it anytime soon. So it's a bit of a watch and wait with APRA and the serviceability buffer rate. But guys, bit of an update on that and what is being lobbied right now. Guys, I hope you took some great value out of today's weekly news bulletin, APS weekly news bulletin. If you did, and you think someone else might take some great value out of it, please make sure you send it on, share it around. As always, trying to build that circle of influence of people who are thinking, talking, and act the way that you and I do about property. And until next week, guys, that's another APS weekly news bulletin on the Scouting Australia podcast.